Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX and again on Saturday morning at 9 on KATX and KWBY as Angela Robinson joins Terry Slavens to share important financial information to help you live life on purpose. Insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
And welcome into Life Planning 101 here on KATX KWBY. Terry Slavens with you, joined by Angela Kennedy Robinson as our regular host of this show.
It's a great day, and we have a lot to be thankful for, don't we?
Thanksgiving week.
Yes. So wonderful things about this week. This week is a great week, and we are going to do nothing less than provide you more great information. Now, I will admit some of this may be a little depressing because anytime we involve government changes, there is some depressing nature. But we are going to have a special guest on the show after this first break, Mr. Blake Briscoe, CPA out of Stephenville, Texas. And I tell you what, we've worked with Blake on some projects, and he has done an outstanding job thinking outside the box. And to say that about a CPA, that doesn't happen a whole lot. You know, we all have what we call our unique abilities.
Right.
And just like, you know, many CFAs and CPAs and accountants is, you know, they think with blinders on a lot because they focus so much in on the numbers. And he really has a gift to do both. And that is huge. So he's going to join us after the break. We're going to be talking about these changes in the Fair Labor Exempt wage threshold, which I think is huge for business owners. You need to know, and you need to be making decisions, this week on what you're going to do in regards to that, because this could change the face of how you pay your employees.
Exactly.
And it's massive. We're also going to be talking about some of those last minute tax savings ideas, which I'm sure everybody wants to hear. So you'll need to stay tuned for that, and things to really watch out for. What is the IRS targeting right now? And so Blake's going to get into some information on that. And so there's a lot with the show. You don't want to miss it. We do have a question for you. We want to know. And by the way, we appreciate all of our listeners doing our Twitter poll. I tell you what, our Twitter poll has just been going berserk over the last couple months.
That's fantastic.
Yes, it's fantastic. So we appreciate all of our listeners doing the Twitter poll every week. We will give you this tweet, and then you end up letting us know after, or when we get to the end of the show, you'll know why. But what we want to know this week is, do you max out your retirement savings every year? So let us know. Tweet us at KFS Life Planning, KFS Life Planning. Do you max out your retirement savings every year? And on a quick note, before we jump to break and get all this going, from now until December 5th, the Eastland County Crisis Center is having a holiday coat drive. And if you've got any gently used coats or want to go buy a new coat or anything that you want to donate, you can bring them to our office at 106 South Seaman Street. I know everybody hit the cold this week, and we all started to feel it.
Wow, first time all year I've may pull over.
That's right. And my nose is sniffling this morning, and here we are. So, and I know there's a lot of people out there that, we think we do live in the greatest nation in the world, but we still have a lot of people that have a hard time being able to buy the things that they need during certain times of year. So your gift would be appreciated. 106 South Seaman, we're doing that coat drive. Make sure you do it. And while you're at things, put it on your list to subscribe to our newsletter. We're coming up on New Year's.
Yes.
And you need to be thinking about your New Year's resolutions. And one of those, of course, should be further educating yourself about how to make your life better, right?
Exactly.
Yes. When it comes to your life, when it comes to your money, when it comes to your estate, when it comes to your family, all of those things we talk about on the show every single week. So subscribe to our newsletter. Go ahead and get one down and done. And that way you don't even have to worry about it after January 1st. Kennedy-financial.com. And you can go to our newsletter and make sure you do that. When we come back, you don't want to miss it. Mr. Blake Briscoe will be on with us, giving us some great information on this thing that could change your business as you know it now. And, of course, those things to watch out for and tax savings ideas. Woohoo!
Tax savings ideas. It's all coming up next right here on Life Planning 101. And welcome back into Life Planning 101 right here on KATX KWY. Blake Briscoe will be joining us momentarily, but in the meantime, it's Angela Kennedy Robinson. Good morning, Angela.
Good morning again. We have got some great information. I say great. It's nothing I guess we sure want to be thankful for necessarily, but we've had some huge changes in this, what we call fair labor exempt wage threshold. And what I mean by huge is I mean huge, okay? Used to, in order to salary an individual, you had to pay them around $23,000 a year, or currently, I should say, not used to, but currently. They also had to meet one of three qualifications. They had to be a professional, administrative, or executive exempt. And a lot of people say, oh, well, mine are administrative exempt. Well, that was kind of a misnomer, because in order to be administrative exempt, they actually have to be in a supervisory position, and they could either, they can hire and fire people and discipline them. So when you think of administrator, you don't think of that necessarily when you have administrative work in your office, but that's what it means by this code, okay? They could also be that professional or executive, meaning they own 20% or more of the business, right? And they would qualify, and as long as you paid them, around that, whatever that number is, of $23,000 a year, and they met one of those qualifications, you didn't have to pay them overtime. Well, we had a little bill come out by our President Obama, and I got to kind of tell you the backstory on this, because I understand where it came from. It actually came from the fast food industry, where they'd have these managers, and they'd pay them a really low amount, and they'd have them working 80 hours a week. And so ultimately, when you calculated it out, the managers were making less than minimum wage, okay? And they said, well, you're abusing this. So they said, we've got to bump this, because these people can't live off of this. This isn't functioning. So, of course, it's just like one rotten apple ruins it for everybody, right? This was one of those scenarios, is there was a rotten apple that kind of ruined it from everybody. And that increase is jumping from $23,000 to $47,476. Wow.
Big increase.
Wow. Yes. Otherwise known as $913 a week. Okay. If you want to break that down, that's massive. Okay. So I think, at this juncture, we've got to look at our business, and we've got to be able to say, what is my business going to be able to afford? What am I going to be able to do? How should I do this? Because everybody always thinks, well, I could do flex pay, right? If they work this, they work that. Under these rules, it all has to be in the same week. And why is this such a danger? Okay.
So you can't work 60 hours this week, but only 20 hours the next week.
That's right.
Offset it.
It has to be in the same week to get that flex pay to work.
Gotcha.
Yeah, for overtime. It's interesting, because the DOL is making it harder and harder for these small businesses to run their businesses, right? And it's going to have to be some big decisions, because here's the problem. The bigger issue, okay, is the moment you get reported by one employee. Doesn't even matter if it was fact, fiction, whatever. The moment you get reported, you have a DOL audit. And supposedly, a DOL audit is way worse than any Internal Revenue Service audit. IRS, you heard me say it, DOL is worse than the IRS.
Wow.
Than you could ever get, okay? Because they are going to be after you for every little thing you've ever done. Think about that.
Yes.
Wow. Ouch.
You do not want to get into that situation.
No, you don't want to jack with this. So
one quick question: how does this affect educators?
So everything is the same. I mean, it doesn't matter what this is industry abroad.
Because a coach.
Yeah. Now, if you are part of a government entity, they have their own set of rules. So, yes, and I think I think they've been more strict, and I think they continue to be a little more strict than what it is. But, I will say you've got a really good resource for this, and close by, okay? The Small Business Development Center in Abilene, they actually came to Eastland, and we had a little meeting here where Mrs. Becky Green, she's been in the business for years and years and years, worked at Texas Tech, done human resources, very well educated in this area. She came and did a little educational class on this, and we got to act and interact and ask questions, and it was wonderful. I can't tell you how much I learned being in there. And the good thing is she's right here, and the Texas Tech Small Business Development Center, they do things pro bono because they want to do it for their schoolmates. So you can actually send them your handbook. You can call and talk to them, get advice on how to, what you should do in your particular situation, because this is serious. Okay, we've got paid time off, for instance. A lot of people don't know this, but when you salary and employment, and this is something I learned, when you salary an employee, if they come in and they work 15 minutes in one day and then they get sick and they go home, that's not paid time off. Interesting.
Yes.
Isn't it? Okay. So there's a lot of little caveats that you probably really need to be in tune to with this, because this is huge. And to make that jump from 23,000 to 47,000, I mean, we're having to go through this, in our office as we're looking at everybody's situation and saying, okay, does this make sense or does this make sense? Because anything less than that $47,476, you're going to have to pay overtime. You're actually going to have to keep track. People say, okay, so what do I do, right? Okay, if I don't have a salaried employee, now what do I have to do? Well, now it's all about the record keeping. All about the record keeping. You have to make sure that you're keeping the timesheets on everybody. And when they work overtime, guess what you're paying them?
Time and a half.
You're paying time and a half. So I think this is a very interesting thing that has come down the pipeline. And I don't think small businesses are prepared for this. I think there's a lot of small businesses that don't know this, and I would hate to have some backlash. Oh, and by the way, there's another little thing in this rule. Okay, we've got this little cost of living adjustment, right?
Right.
All right. Well, every 3 years, they're going to incorporate that.
Okay.
In that cost of living adjustment. So
let's see if we have Mr. Blake Briscoe on the phone with us this morning.
Good morning, Blake.
Good morning. How y'all doing?
Well, we just got through talking about all of this fair labor exempt wage threshold, the background of it, and what it really could mean for businesses. And, the biggest question we have for you is, from your side of the road, where you're coming from, helping people on the back end. And I always call your job a cleaning up messes job, right?
That's right.
You get to do. Right. So from your side of the road, what are you seeing that could be some pitfalls, or what do maybe businesses need to be doing right now to, to make these decisions?
Well, mainly what we're seeing is basically 3 different options is that they have. I'm sure there may be some others, but this is basically the premise we're taking. Is one is that they're either going to have to increase the salaries that they have for the people and bring them up to if they're going to leave them as an exempt employee, and that would be one option, and therefore not have to keep track of overtime rates and stuff like that because they're being paid salaried and they actually adhere to the rules with that. The second is to actually continue to pay them a salary, but keep track of your hours, and if they do work overtime hours, pay them overtime. And the third then is simply go to change them from a exempt status to a non-exempt status and actually pay them hourly wages based just like they would any other staff member. So it really depends on what options they choose to go with.
Yeah, and it's some tough options. We got through talking about that flex pay has to be within the same week. And I know for a lot of small business owners, that's kind of the perk of being a small business owner, right?
Correct.
And,
that is correct.
And the perk for the employees is, hey, we're a little bit more lax. Go to your son's PTO program and do this, and then hey, will you help us with this night this week? So,
right.
And that's disappearing.
It is.
We're
You're
not going to get that.
Right.
So, that's a really scary thing.
It can be, and it's made a lot of people relook at what they're going to do and how to handle it. And so they've got some important decisions to make pretty quickly because it comes up December 1st.
Yes, they do. And one other note with that. So a lot of you may be thinking, well, what if I just start paying contract labor?
Well, yeah, that's a whole nother world, and I always caution people. I mean, if they're actually employees, paying them contract labor is really not a choice. If they are really an employee, and you have to, basically go through a stepped process of looking at different thought processes, and I think IRS has a form that you can actually step through and try to figure out whether or not they are contract. But basically, if they're an employee and you're controlling their work and telling them what to do, you really are not allowed to pay them contract labor. You can wind up getting yourself into serious water with that.
Right. In fact, I mentioned, they had that Small Business Development Center from Abilene come and talk, and one of the things they said is the IRS is targeting this really hard.
They really are. You're exactly right. Anything with self-employment taxes of any kind, they're looking at.
Yeah, and they said something about on the 1040, there's actually a question on the tax return that they're going to be putting or have put already that, are you really an employee employee, not contracted labor, and they won't penalize the person that answers that properly.
That's correct. Yes, and if they answer it like that, then the scary thing is that if they go back, and now this is unless the rules have changed with this, which I don't believe it has, the employer or the person paying contract labor can actually wind up being responsible for not only their portion of the self-employment taxes, as in a W-2 setting, but the employee's portion as well. So it can be pretty nasty.
Wow, that's harsh. Well, yeah. Blake, we're going to take a quick break. When we come back, we're looking forward to. I know everybody has stayed tuned to get through all of this horrible, nasty stuff that we have to deal with, to learn about some little year-end tax savings ideas, and of course those things that we really need to be watching out for as well. So thank you again for being on the show, Mr. Blake Briscoe of Stephenville, Texas. Like I mentioned, we gave you tons of accolades before you came on the show. You've been just a lifesaver for many of our clients, and what you do to be able to help them think outside the box and skin the cat other ways than just one, right?
There you go.
All right. We'll look forward to when we come back hearing from you. Thank you.
Thank you.
All right, we're going to take a break. This is Life Planning 101 right here on KATX 97.7, KWI 98.5. And welcome back to Life Planning 101 here on KATX, KWBY. Angela Kennedy Robinson, and we're joined by our special guest, Blake Briscoe. Good morning.
Good morning. So we have we saved the best for last, right? I guess. But before we get into that, Blake, you made note of something when we were talking about what we were going to do on the show, and this was something that was kind of news to me, but I think is very applicable. Since all of our listeners are either in the Eastland County area or Erath County area, on this farm and ranch. Talk to us a little bit about what you're seeing here and what people need to be watching out for.
Well, I think the things that we had actually went through a CPE course, and they were talking about this situation and talking about that if you were a rancher that raised cattle and whatever else, and then on the side you decided to, I don't know, whether it be custom combining or build fences or whatever you might choose to do, that's actually a service. And as long as it is a small amount, it's something the IRS just overlooks and really doesn't pay attention to. But if it became something that where you actually wound up with a substantial portion of your ranch business, and you were using basically the investing that same money back into your ranch and increasing your herd, the problem that you might have is that IRS can actually split out that business because it's actually a service organization instead of a ranching operation. And so all of a sudden you'd wind up with a Schedule C that may be a profitable organization, and you could wind up with other situations that would spin off of that could be an issue. And so we try to work with our ranchers to be sure that if you're doing something like that, let's if it grows, let's start looking at that, if what we might have as an option that we may need to look at.
Yeah, and I think that's really important, because a lot of people they overlook things like this, and then you end up getting slammed because you do have self-employment tax, and you've got all these other things that need to be applicable, where through your farm you may have created a loss for yourself and you think you're okay.
That's correct. Yeah, as well as other issues.
Yeah, that really caught my eye. Is there anything else that you're seeing out there that people need to be cognizant of or kind of watch out for as they're getting into that tax mode for next year?
Well, I think mainly one thing that's really important that people need to remember is this year we've got filing date changes for partnerships and C Corps. In the past, partnership was not due till April 15th, but it's now due March 15th for this year. So you got to get them done quicker. And C Corps used to be due on March 15th. They're now due April 15th. So they switched them, which kind of makes sense because they're partnerships a flow-through entity, and the K-1s need to go out to other people in order to be able to do their own tax returns, and C corporations are taxed inside of themselves, so that made sense to do that. With a lot of people, I tell them to watch out for your itemized deductions at the end of the year. If you're actually considering whether to pay your property taxes, if you're able to itemize, don't wait until January to pay your property taxes. If that would help you in your itemized deductions by paying them before the end of the year. That kind of is a little kicker there that can actually be overlooked. Keep good track of your mileage records, and consider if you do need to do some tax planning that you use a credit card, then that is considered an actual expense if you charge it on that. So if you're looking to buy some or spend some money to save some taxes, you can use a credit card. Hate to tell people to do that too much, because that of course incurs debt, but it can be used as an effective tax planning tool if you have the money to pay the credit card off after you've taken care of it, and in a quick pinch right there.
Sure. No, that's really good information. And, I know a lot of people, and we're running out of time here, but one thing, especially since we're kind of talking to these farmers and ranchers and business owners today, is the home office. A lot of people don't take advantage of that, and they're kind of scared of it. But I've heard you say over and over again, as long as it's done right, there's nothing wrong with it. So
that's exactly right. Yeah, if they've got a home office and they actually have one, and they have an office they're using at home, they're throwing a deduction away that they could be using. They sure are.
Yeah, that's huge. And a lot of people are worried, I have to recapture that on the back end. Well, there's news for you. You can 1031 that into a new office. Isn't that right? If you move.
Well, you can do something like that, but typically, if somebody is going to sell their personal residence, which is where that would become an issue because of the rules as they stand now, then the gain is actually basically covered up to $500,000 if you're married filing jointly. There can be some tax implications, but I can honestly say that so far with everything that I've done in history, I've not had a home office come up and actually create any tax on a tax return. I guess I should knock on wood. That's been the case as so far.
Yeah, but that's great. That's really good to know, and our listeners need to hear that. So, Blake, thank you so much for being on the show. We do want to encourage people on our end, make sure, and I'm sure Blake would vouch for this, is, with your retirement vehicles, your 401ks, your Simples, your IRAs, all of those things, max them out, utilize them, okay? Utilize your health savings accounts, max those out. I love that. We talked about them several times. If you've got questions, email us, Kennedy-financial.com. You can email us and let us know what those questions are. And don't forget our tweet. Are you maxing out your retirement savings? Yes or no? Thank you for listening to the show. God bless, and happy Thanksgiving.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX, and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Advisory services offered through Smart Money Group, LLC, a registered investment advisor. Securities offered through Calton & Associates Incorporated, member FINRA SIPC. Kennedy Financial Services Incorporated is an independent of Calton & Associates Incorporated and Smart Money Group, LLC.